Hello friends, welcome to the channel guys. In this video, we're going to discuss something very important, which is how to value the market and basically come to an understanding whether the market is overvalued or undervalued. Meaning, if we enter the market at the right stage, when it is undervalued, we have strong chance of making money. But if we enter the market at the very top, we have very less chances of making money. So market goes in cycles, right? Cycles like this. So in any developing nation like India, or growing economy like India or US, market goes try to in the long run, market generally goes up, but it does not go up in a straight line, which is the mean. It goes in a zigzag fashion. It follows cycles, and all these cycles are then divided into multiple mini cycles, right? So what we have to basically do is try to enter the market when it is undervalued, and try to exit the market when it is very high, so that we basically avoid that drawdowns and get maximum gains, make maximum gains, right? So this is what we're going to discuss in this video. And how can we actually do this? So um, people like Warren Buffett, um, you know who are the stalwarts of investing, they, although they propose to the common public that you should invest and stay invested long term, right, like forever, but actually they also do this basically. Right now, if we'll just see, Warren Buffett is sitting on a lot of cash. He's waiting for the right opportunity. Now, because the portfolio is too big that they cannot make multiple entry and exit, so they just exit it in cash and wait for the right opportunity next, right? But you and me, we've managed, let's say, under 100 crore of portfolio. For us, it makes complete sense to make maximum returns. Basically, if we go in, into the market after exiting, within 100 crores, it should not be a big problem, right? If we do it in the liquid assets or liquid stocks. So keeping that in mind, we will discuss three main um, um, indicators here, which will help us evaluate whether the market is overvalued or undervalued, right? So the first is ROC indicator, which is the rate of change, right? The second is EMA 400, and third is um, Nifty to gold ratio, right? When you basically test the current market situation, and I'll show you basically in TradingView now next, that how using these three you can evaluate whether the market is overvalued or undervalued. And right now it is one of the best times. Although this video is not an investment advice, you are the judge of your own um, decisions. But if you just um, apply this common sense from this, you will be getting a fair understanding whether this is the perfect time to buy or to sit it out. Because according to me, it's one of the good times to take a position in the market. All right, so now going to my screen. All right guys, so the first we're gonna check out as Nifty 50. So for Nifty 50, you just add the Nifty 50 index over here, and you add so I'll just show you how to add this. This is the candlestick chart of Nifty 50 on trading view. So if you go to the trading view and you put up in the watch list Nifty 50 and add it here, it will open up as this candlestick chart. And then what you have to do is you have to go to indicators and put ROC over here, rate of change, and this is your rate of change indicator, right? And in this rate of change indicator, then you have to go for settings, and you have to go for the length as 20 periods, and I'll tell you what this is, and the time frame as 1 month. Okay, so this is how it will appear then. And now if you put a line here at 30, let's say at 40, right? let's say 30, 39, 40. Put a horizontal line here, and the another line is at 0. You will see that whenever this is one of the ways, by the way. There are other ways also to value the market. You can check the P by E ratio of Nifty 50 whenever it is going above 24, and I've created videos on that before. It shows that we are getting towards the overvalued zone. But here also you can simply analyze with this ROC which part of the market cycle we are in. So whenever it touches or crosses over 40, the market shows the signs of trend reversal, and it goes basically there will be a period followed by which for a year to a couple of years, where until this ROC indicator comes down to 0, that market becomes undervalued again and starts to go up. So it doesn't make sense if you invest at the top, right, when it is overvalued. Okay, so um, now what this means, ROC indicator. So ROC indicator basically means, since we have set the period as 20 and time frame as 1 month, that over the previous 20 months, from the last 20 months, what is the return of Nifty 50. So at this stage, when it's today, it is minus 7%. That means from the last 20 months, Nifty 50 has given minus 7% returns. Likewise, when it is 40 here, that means from the last 20 months, it has given 40% returns. Now, why this trend reversal happens? Because the market, whenever it goes up or a stock price goes up, it goes up because of two reasons. First is the earnings, and the second is the PE multiples, or the multiples people are going to pay on the share price, right? So the realistic momentum behind a stock's prices growth should be the earnings, right? So whenever, but the earnings we have seen Nifty 50, since it is a large cap index, most of the large cap companies grow at a rate of 12 to 14% in India, right, year on year. So over, if you just evaluate for 20 months, which is close to 1.5 years, you should not get more than 20% return. But if it is growing at 40% over the last 20 days, that means it is doubling, right? Which is not true. So that means the price multiples have built in, and market is gonna show the tendency for reversion to mean, as we can see from the previous trend analysis. And by the way, this video is for research only, guys. This is not an investment advice, so take your own judgment. But this is a good tool to value whether the market is overvalued or undervalued, right? And this we can do this from this. Fair enough. So if you have any questions, do let me know in the comment section below. Now the second indicator which we can use is again exponential moving average. If you go to the indicators here and add moving average exponential, it will add this. And then what you have to do is go to the settings here again, and make the length to 400 and shift this chart to a daily time frame. Now when you do this, you will see that whenever this EMA 400 line, which is exponential moving average, this is basically the average of the last 400 days built into the price, and this works as a very good resistance line, right? So whenever the price is touching this 400 EMA, it has shown to show the signs of reversal, right, later. So you can see this from this Nifty chart before. So it forms a beautiful resistance on a daily time frame, right? Now exponential moving average has a recency bias, so it is more biased towards the recent few days compared to the last 400 days, but still nevertheless it is very good. So whenever it shows, whenever this line touches whenever the candles start touching the 400 EMA, then it shows basically that the market is gonna show signs of reversal and it is undervalued. And right now it is trading below 400. So you can make out what this could be, right? And the third indicator is basically Nifty to gold ratio. For that you have to do basically go to the symbols here and write Nifty slash, or which is also divided by gold. So and just put enter. So you'll get something called as Nifty to gold ratio. Now what you'll do is you basically reduce this time frame, and this is what it is. Okay, so it's basically the division of Nifty price versus the gold price, right? And what this ratio basically means is that how to read this data is whenever you can form a trading channel for this, and it goes in a trading channel. So in the long run, the Nifty returns will outperform the gold return. That has been seen consistently, right? And it has been seen that from this, that whenever in this channel the prices are touching, this ratio touches the top trend line, then it shows a reversion from there. Basically people are getting out of equity here and going into gold, and whenever it touches the bottom, that means the gold is overpriced and people are touching to moving to equity. So right now again this ratio is touching pretty much the bottom, which is people are moving out of gold and entering the equity portfolio. So these are the three things which we have taken here to value the market. And yeah, so I hope this was helpful. Do let me know in the comment section below, guys, what do you think about it, if you found this useful. And yeah, I will see you again in the next video. Till then, take care. Bye bye.